bunch of people here today. Kind of a smaller group than normal, but welcome to the Hurley Investments Financial Services Commentary for Tuesday, the 24th, April 2018. Pretty interesting. What I'd like to talk about today goes along with an email I sent out to clientele. And the short answer is, if I was to tell you the market is confused, would you agree with me or not? What do you... Good answer, David. I don't know how you type so fast. David said 100%. Maud says I'm confused. In fact, Lance says that it's very uncharacteristic, and I might come back to that word. I don't know why I used uncharacteristic, but that is I might say, since we're in this new market, I guess it is very uncharacteristic, although I'm not sure what we would expect right now. Mary says very confusing. It's funny because I think you can point to numerous reasons why the markets could go down. In fact, if I could just put in here, let's think about it. What reasons do we have for the market to go down? Shoot them off at me. Which ones? What do you think you have here? What reasons could you say for our market going down? There we go. End of a, I'm going to stick another word in there. End of a historic bull run, if that's okay. So as I'm sitting here teaching this class for my Tuesday nights, we are at the end of a historic bull run. What is another reason? Technical, there you go, technicals. In fact, if I make a run on down to our chart here, technically what happened to us on the S&P 500? And I've got someone that's, there they go. What do we have that happened with the 500? In fact, if I went and I took a peek, technical crossover. I bet if I was to bump this on down, I bet for sure we would find crossovers on the MACD. Not yet. So technical bounced off the 50-day. 50-day simple moving average resistance, but still technically bullish to the upside because our MACD hasn't crossed. So technicals, technical bounce off 50-day simple moving average. Off 50-day simple moving average. What else could we use? What else could we say? Higher interest rates. Bingo. Higher interest rates, which right now lead to an inverted yield curve, right? Anyone know what an inverted yield curve is? And I'm going to move someone over here that's, we're going to have someone join us tonight. I'm going to keep it a suspense right now. Let me get them over as a panelist, make sure I keep them there. So I've got two staff guys. Okay. So going back to my question, what is an inverted yield curve? It's the only 100% accurate indicator of a recession. Invert yield curve. I'm going to bring it up in my point right here. An inverted yield curve is an interest rate environment which the long-term instruments have a lower yield than the short-term debt instruments. For us, it's the 10 and the 30-year treasuries. If you look at the last graph, we are darn close. This type of yield curve is considered a predictor of economic recessions. My research is correcting the yield curve is 100% accurate. When you have the 10 give you more interest than the 30, sometimes it's the 2, the 3, or the 5, or the 7 versus the 10. Anytime you get an inverted yield curve, it usually is an indication of higher inflation, and it also, more importantly, is an indicator of a recession. 100% accurate when this occurs. With that said, I'm a little frustrated. I'm going to go a little bit into getting a guest here before I keep going through some of the reasons. But I want to make sure that I don't sound too negative. I want to make sure that you don't think, oh my gosh, he's just pushing this to push his own business. I do get this out there quite a bit. I'm going to unmute. In fact, actually, he might be there. Jeff, are you here? Can you speak? Are you connected so we can hear you?
I can hear you just fine, so you got to tell me whether or not you can hear me.
I can hear you. You sound good.
Perfect.
Jeff, give us your explanation or your thought process of what you see in the market right now, and you can call it whatever you want.
Well, thank you, Kevin. I appreciate it. And for those, I know some of your some of the people that are here with you and listening to you know me a little bit and know me from my education program. For those of you that don't, my name is Jeffrey Dunyan. I run Safe Option Strategies, an investment education company. Kevin and I talk a lot about what's going on in the market. We talk a lot about trades and strategies and so forth. I'm going to steal what I heard someone else say today, and I wish I could remember his name because I'd like to give him credit, but I just couldn't help but completely agree with what he said. I was listening shortly after the market closed, and here's what I see going on as far as, and are we talking primarily about today's sell-off? Is that, I came in a little bit late, is it primarily today's sell-off that we're talking about?
Well, it's actually the last 3 or 4 weeks you have these large gyrations, and shame on me for not doing a better job of of introducing our guest speaker today. But
that's okay.
You can call it today. You can call it really the last 3 or 4 weeks. You can find the same type of bounces or weird up 132, down 500.
Let me comment on today, and then I'll just make a short comment on kind of the general conditions over these last 2 or 3 weeks. As far as today goes, you had the perfect storm. And here's what I think the perfect storm consisted of. You've got some of the Dow 30 components. 3M, I think, was one of them. Caterpillar was one of them. There's probably another one in there that I'm not remembering. There were several Dow companies that reported their earnings today. And
Boeing didn't report, but they were down.
Okay, and here's what's going on with earnings, not just today. This has been going on for a while, but we felt the impact of it a little bit more today. There's 3 things. There's a trifecta that has to take place in earnings for a company to go up. They've got to beat on the top line, they've got to beat on the bottom line, and they've got to have positive guidance. So top line, they've got to have revenue that beats the street. Bottom line, they've got to have profits that beat the street. And then they have to give a strong guidance for the next quarter, the next year, whatever. And what's been happening is if there's a miss on any of those 3, and I think personally, I think this is very unfair, but it's reality. It doesn't matter if I think it's unfair or not. If there's a miss on any of those 3, companies are getting punished. And Caterpillar, more than anybody else today in their earnings conference call, they hit on their top line, they hit on their bottom line. Their revenues increased, their profit margin, their profit dollars, whatever you want to call it, increased. Even their guidance statement was not negative, with one exception. They said, we've probably hit the high water mark. That was actually their words. They said, we're not going to have as strong and as good an earnings the rest of this year as what we had this quarter. Now, here's what's crazy about that. They didn't say they weren't going to be good. They didn't say that each successive quarter would probably beat the previous year's same quarter. They just said that they don't think they'll have a quarter the rest of this year as good as the one they just had. And that, they missed the trifecta. They got 2 out of the 3 exactly right. In fact, they crushed it on 2 of the 3. But the third one, they missed on, and they got severely punished for it. Now, combine that with what I heard when I logged in. I heard you talking about the 10-year bond rate, the 10-year treasury rate, whatever you want to call it. There's a panic over that hitting 3%. And Kevin, I hope I don't offend any of your listeners, but I cannot tell you how much it pisses me off the way the mainstream financial press, and I am talking about CNBC, I'm talking about Bloomberg, I'm talking about Yahoo Finance, I'm talking about Google Finance. It absolutely infuriates me how they perpetuate the fear of a 3% bond rate. Do you know how low 3% is traditionally? Now, granted, we haven't hit 3% since January of 2014, but we have been so artificially low at being below 3%. And what's happened is the talking heads, the commentators on these financial stations, they have been stoking the fear. They have been talking as though a 3% bond rate is going to cause every penny of every 401k, every mutual fund, every hedge fund, every individual trader is going to run away from equities and run away from stocks and jump into a 3% bond. The next time I make 3% in the market in 1 year, I'm going to give up completely, because I have not made less than 45 or 50% a year going back, I don't know how long. I got to go back to 2008 when I made 20% to see the last time I made less than 40. The idea of running from the market to go to a 3% bond rate is so asinine. It is so foolish. And yet these morons that call themselves experts, these absolute Trump-hating, American-hating idiots that are supposed to be journalists and supposed to be objective, are stoking the fire of fear to make the administration look bad. Now that is my opinion, not necessarily the opinion of Kevin Hurley or Hurley Investments. I'll give you some protection there, Kevin, because I know I'm really on a rant on this. It's not my intention to offend anybody, but that is what is going on. And when that bond rate hit 3%, it took a little while. It took the absorption of the earnings reports and the miss on one of those 3 things that had to be there, combined with the 3% that we hit. And things just, the bottom just fell out. And here's the reality. I'll say one more thing, and this is the reality of our market right now. As much as we may not want to follow all the lemmings that will just do whatever the latest commentator on CNBC says, however we want to not be that following lemming. If we don't carefully follow the rest of the lemmings, we'll get trampled by them. That perfectly stated, Kevin. I see you typing in herd mentality. Perfectly stated. You can't ignore the herd mentality because you'll get run over. You've got to figure out how to effectively manage your positions in that herd mentality so that you don't get run over by the herd. So for today, big companies in the Dow not hitting the trifecta on earnings, bond hitting 3%, and the media stoking the fire of fear. That is what caused today's sell-off. In a more general sense, the up and down volatility is that we have come to expect too much out of this market, and expectations are so ridiculously high that if a company is not crushing it, I mean absolutely crushing it on all 3 of the criteria, they're getting punished. And there is a lot of fear in the market right now. I noticed you put higher than average volatility. What did I hear? It was up 17, 18% today on the VIX. I think the VIX had a 17% increase today. That's huge. That is absolutely huge. So that's, Kevin, I can't spend a lot of time with you. I wanted to spend this presentation with you. I had a situation come up with a neighbor that is on his way to the hospital right now. So I came in to say my piece, say hello to everybody, tell you all that Kevin is brilliant and knows what he's doing, and I don't get paid for saying that.
That's why I have you here.
And unfortunately, now that I've vented like that, I probably have to run in just another minute or two.
Piece of cake. Let me type anything else in that you want to, and I'll get you unmuted again. Always good to hear from Jeff. And it's funny because he said we talk a lot. And as I wrote my email out to the group, the market just doesn't make sense. And as Jeffrey talked about lemmings, if I knew how to write lemmings, I would have put it in there. I've read the book to my kids. But it's that herd mentality. It's that ETF rebalancing. It's, an ETF can't have guns, anything related to guns anymore. So exit out all the Smith & Wesson. And it's just really, really unbelievable what our market is doing. Someone has made the comment that maybe the tax and deregulation are built in. Maybe in financials, which doesn't make any sense as I say, but financials expectations are to have to beat 20% year-over-year growth. Because this is one of the biggest ones that's going to be hit with, they're going to be benefited both by a higher interest rate and the tax benefits. We can keep putting more stuff in here on what reason do we have for the markets to go down. And the part I was going to bring up is maybe to a certain degree, everyone is right. You can there's probably not a person that can't find something that literally says, hey, it's this. Hey, it's this. No, it could be this. There are so many different things to look at that you can blame the lack of movement of the stocks on, that it's all over the place. Out of our group here, is there anything else I've forgotten? End of historic bull run, technical bounce off of 50 days of moving average, higher interest rates, which might lead to an inverted yield curve, earnings trifecta. That earnings trifecta expectations are higher than expected. When Jeffrey talked about the 3% bond yields, this really comes down to that 60-40 growth, quote unquote, balanced portfolio. And it's really been closer to a 70-30 to a 75-25 has been a growth portfolio with 75 in equities, 25 in bonds. When it hit 30, you saw a big rush into bonds. It's churning. It's churning from the herd mentality investor that basically says, hey, by the way, I have a new bond for you. Even though we put you in a bond 3 years ago and you're just now breaking even, let's sell that bond for a loss because I've got a new one that's making 0.75% can now make you 3%. Oh yeah, and they get charged, or they get to make 6-7%, and they might take a 4 to 5% loss on a bond that's now selling at a discount because it has such a poor interest rate. We have a higher average volatility. We have the herd mentality in and out of positions that are seen on TV, as well as I call it ETF herd mentality now. Maybe tax and regulation already baked in. A lot of people said, well, it's kind of baked in January. We lost all that. Well, it was baked in the year before. Maybe that is. Financials haven't grown. Anything you think I've missed here? Dave, oh, you're killing me. Dave typed in Democrats. I'm not going to go that far, but I would agree with you 100%. Political uncertainty from Democrats, Republicans, Twitter. Is there anything that I'm missing here? Kim Jong-un, there you go. So yeah, there could be a quite a bit here that you can explain it. I'm going to give you my email. This is my email out to the group. Pretty interesting. Spend some time going over the third, fourth paragraphs. Those are yield curves. It's more economics, but pretty interesting. With that said, tell me what's happening this week and why. What's happening this week? This is stuff you guys should know. 69.4 versus an estimated. What's happening this week that we need to be able to pay attention to? The only real uncertainty, who is China? Possibly. Next did 694 versus an estimated 631. So new home sales came in better. How about consumer confidence? Consumer confidence came in at 128.7 versus an estimated 126.1. Oops, sorry guys. We have the FHFA, Mortgage Purchasing Index, that came in today at a 0.6 versus an estimated 0.5. And of course, we have Case-Shiller. Come on. Which came in at a 6.8 versus an estimated 6.4. All good news. All good news. Interesting comment. New homes will be affected by the 3% as of today or not. They're affected by the higher interest rates, not necessarily by the 3% of the treasuries, but the higher interest rates give banks and the opportunity to increase the spread, to charge a little bit more. So new home buyers, looks like they're trying to buy in through this summer season to miss out on a 3.5 to 4.0 interest rate with good credit coming up here with another 50 basis points of rate hikes coming in, most likely October and December. I found it interesting, Jeffrey noted that Caterpillar said that this may be, their high water mark for the year. Any reason why Caterpillar would say that? Same thing with Deere. Why are they going to say that? I do know higher steel and metal prices, should say commodity, is occurring right now. With that said, Freeport-McMoRan had a pretty dismal earnings. They're supposed to come in at 56 cents a share. They came in at 46 cents a share. Really missed their earnings. It's like they're not taking advantage of the higher metal prices. Kind of surprising because gold has gone up. Silver's been pretty stagnant, but Freeport-McMoRan can't seem to make money on its oil, on its natural gas, or for right now, it's gold or silver. So because of the big drop today, I would say markets are going to go higher. If we take a peek at the Dow, boy, I missed a little too big. Need to shrink it down just a little bit so we can see it. There we go. Looking at the Dow, well, we'll go a little bit more. It's shrinking a little bit more for me. Obviously hit the 50-day. Don't quite have the crossovers down below, but it could be a 50-day technical bounce. Boy, we hit it hard, huh? Come on, computer screen. 50-day simple moving average. Resistance. Bounce down. Almost technically bearish. We went through the S&P. Boy, kind of same thing with everything, right? At least on the indexes. Technical, 50 days simple moving average, resistance, bounce. Where are we going to end April? I'm going to actually change this to May. I want to go to May. I'm going to send you guys out a poll question. Let's do a poll question. Haven't done one of these in a while for you. Your screen's going to have a question for you. There you go. Take a look on your screen. Give me a vote. Where are we going to finish May? 2,800 is not even the previous high, but it's a resistance. 2,750 is a resistance level. 2,699 actually should be 88, but 2,688, 2,699 is the 50-day. 2,607 is the 200-day. 2,575 or lower is the previous lows for the year. So where are we going to finish May? Take a quick look at your screen. Wow. All right, I'm going to give you 10 more seconds. 10 more seconds, I'm going to close it down. It's pretty amazing. That is really amazing. All righty. So for a while there, it was 50-50, 2750, which means a breakout above the 50-day simple moving average. We had the other 50%, they were down at 2575, which were the year lows. Then out of the blue, we had 4 votes that came in, and you all said that 2688, 2699. Again, that coincides with the 50-day simple moving average sitting right here. It all depends how you calculate it, but that 2688 to 2699 means we're looking at being in a pretty tight range, a 68 to a 67. We're looking at an 81-point range right now. 81-point range is the range we're looking at to possibly move here in the next month. With earnings, I would have set it at 2750. I would think we'd go back to some resistance, a gap, a little gap. I do think earnings will push us higher, but I'm not sure how high earnings can push us. So it will be interesting today to see where we're going to be at. It's very interesting to see if in the next month that maybe we get, I don't know, a little farther, a little higher up, a little more movement, who knows. But I would tell you, looking at a chart, no one really is making a comment. No one really knows right now. And I think that's pretty accurate. I think we're going to get back to stock picking, where individual stocks like today, like Verizon, bucks the market because of its earnings. I didn't finish it. So Verizon bucked the market. Let's see. Tomorrow we have Boeing. Nope. Yep. Tomorrow we have Boeing, Dr. Pepper Snapple, Hess reports, DC reports, Sohu, something I follow because of Baidu, Twitter reports, AMD, AT&T reports, CMG, which is Chipotle, eBay reports, KBR reports tomorrow, PayPal reports tomorrow. Then my big ones, Visa, Ford, and Facebook. Those are mine that I'm going to particularly follow tomorrow. Moving on, Thursday, ridiculous. American Airlines, Altria, which is one I follow, Bristol Myers, the CME Group, ConocoPhillips, D.H. Horton reports, International Paper, MGM, Newmont, Pepsi Company, Raytheon, for those of you that have the Raytheon trade, you're looking at hopefully a bump up. Otherwise, you might have to run a bull call through earnings. Amazon tomorrow on Thursday. First Solar on Thursday. Intel on Thursday. Microsoft on Thursday. Starbucks and the ones that I care about. Actually, let me take that back. Xsteel, Western Digital Corp. And I said Altria, but Baidu. Baidu is my big one. And then on Friday, we have Clorox, Dominion Energy, CVX, I believe. CVX, sorry. That should be Chevron. Chevron is CVH, right? That is Chevron. PSX and EFC Corp. CVX, it is CVX, huh? Chevron is CVX. I don't trade Chevron. Economic reports for the rest of the week really comes down to Friday, GDP, that'll be a market mover. There is nothing internationally that's out there that pushes anything except for China's CFLP manufacturing number, which comes in on Sunday. That'll control our Monday morning futures. I am preparing for earnings, so I'm here for earnings. And we go from there. Hold on one second, guys. All right. So, here's my earnings list. One I do a couple weeks before. I did find a couple interesting articles. Not that I necessarily agree with all of them, but a hangover has kept markets from pricing in the explosive earnings, a market watcher says. In all honesty, Karish Lahif, don't know him from Adam, not a really popular journalist. A couple interesting comments, and I see he's done some studying. So just want to point that out. 10-year Treasury yield inches away from the 3.0 level that could cause shockwaves in the financial markets. We're seeing it right now. I think I picked this one up a week ago. So pretty interesting to have that out here. Read about that. U.S. stocks could slide 30-40% interest rate volatility, Wealth Advisor predicts. This is a Taurus Wealth Advisor. They call him executive director. I don't know Rainier Michael Prius, but I have seen him about. Pretty interesting on some of the things that he said. There's a video that could go with it if you go to the link. And last but not least, 10-year Treasury top 3% for the first time since 2014, a key interest rate milestone that should ripple through the financial markets. Just some information there for you guys to read. Any questions you have for me tonight? Any questions that I can answer for you or that you have for me that I can throw a couple things out there and give you an opinion? In fact, you know what? I'm going to unmute Jeff really quickly because I bet Jeff will have a couple comments that we could close on as well. Give me a quick second and get Jeff here. Jeff, where are you? Jeff is an attendee, a panelist. Jeff, you are unmuted.
Hey, there we go. So sorry I had to leave for a little while. I said my piece, I left, I came back. I probably missed most of the good stuff. Kevin, can you slide back to that headline about the 10-year Treasury? I just without going on another crazy rant, right there, that's perfect. Without going on another crazy rant like I did at the beginning of your presentation, let me explain really quickly why I made one of the comments that I made. Look at that headline, and I know for a fact because I read it this morning, that is a CNBC headline. 10-year Treasury yield tops 3% for the first time since 2014, a key interest rate milestone that should, that's the key right there, that should ripple through the financial markets. The reason I went on the little rant earlier, and the thing that upsets me so much about the way the media stokes the fire of fear, is that is the writer's opinion, probably a shared opinion by most of that network and by many others, and it is absolutely false. A 3% 10-year Treasury yield should have no effect on the market. It should have no effect at all. It is a non-issue. It should mean nothing to anyone. And yet the headline that they write is a key interest rate milestone that should ripple through the financial markets. The reason I got so worked up earlier when I was talking about this is this type of thing just drives me insane. And this is what so many people follow. So many people say, oh no, the Treasury yield topped 3%. That hasn't happened in the last 4 years. That must be the end of the financial world as we know it. We better get out of every U.S. company that exists is going to collapse because the Treasury yield topped 3%. I'll pull all my money out of the market. I'll give my broker huge commissions by closing every open trade I have, and I'll put it all in the bond market. And then later on, I'll realize what a moron I was for taking everything out of equities and out of the markets and putting it into bonds. But if you don't follow the lemmings to some degree, they run you over. So it is what it is. But I actually shared with some of my students in a presentation this morning this exact same headline, and this is just one example of how you take a situation that shouldn't have an effect on the market, it shouldn't have any type of drastic effect, and it can be perpetuated into this total fear mongering that took place today. Now that doesn't address the broader picture, which is the last couple of weeks, like you were talking about, Kevin, where there's been so much up and down. We take a few steps forward and then we take 5 or 6 steps back, it seems like. So that was all I wanted to say.
100%. I mean, it really. Go ahead.
I mean, I heard you commenting about some of those other headlines, and I think that's excellent stuff. I agree with what you were saying about some of those other headlines, but that's just the example. I found it really interesting that you and I keyed in on one of the same articles that was out there. By all accounts, positive earnings should be pushing this market up, and it just can't seem to get the momentum that'll break it through the fear. And I noticed you've got the earnings listed on Under Armour there for May 1st. Anybody, do you see what Under Armour did in the midst of the rest of the market selling off today? They might have dipped negative just a tiny bit right at the end of the day. I can't remember, but man, they were bucketing when the market was down, when the Dow was down 500-600 points. Under Armour was doing really nice.
It's funny, you hear Jeffrey and I talk about it. The only reason the 3% matters is because it balances the scales from a 70-30 to a 60-40 as the correct mindless advisor portfolio ratio mix. 60% equities, 40% bonds. Hey, at 3%, we're 5 times the interest of the German Bund. We're 5 times plus the interest of a Japanese treasury or bond. That 3% psychologically moves or shifts a ginormous amount of advisor activity. And mark my words, that advisor activity is nothing more than a way to churn you out of a bullish market into a fixed rate, cushion their pockets, 6 to 7% bond churn, where, hey, I put you in these bonds 4 years ago. We need to churn you out, or you're going to take a 5 to 6% loss. They got paid 6, 7% 4 years ago on 30, 40% of your portfolio. You just took a hit. Now putting you into bonds are going to pay you 3 times as much, but you still pay a premium for him, and he still gets the 6 to 7%, so don't break even for 3 years. It's just a, part of me, I'm going to say this, it's just a jerk off. You want to know what this 3% is? It's the biggest jerk off of this decade is what it's going to be, and it's going to cost people double-digit returns in their portfolio. Someone asked, and thank you, I got 2 questions that came in. When it came to, where was that? We have Abraham. You asked, would Jeffrey here for next week's candidates for collaring? Is Jeffrey differ here with you? Not really. Really, where Jeffrey and I differ from stocks to go into, it usually comes down to the amount of money we have to be traded. Jeffrey's got a bigger portfolio for his family stuff that he manages. And you'll probably see Jeffrey more in American Outdoor Brands and Under Armour. PayPal is there that you don't have on my list here. Best Buy he trades. There's some that I don't trade in those regards. I've got, I can kind of put in here. I did think it was pretty interesting. When it comes to how we did today, some of the money that's individual money. Where did I hide this? I'm going to hide it right down here. On a day like today, where make a quick run to CNBC, home, where the Dow lost 1.74%, the S&P lost 1.34%, the NASDAQ 1.7%. I'm not going to say, hey, guess what? I made it all back, but pretty cool that on 7 million, we were down 40,000. So if I do that math, 40,000, 457 divided by 7.5 million. We were down a half of 1%. So while the market was down 1.34, 1.7, we were only down a half of 1%. And if you go to other advisors and 401k stuff, we could do that. Even better, down 50,000 on 10 million. So it's 50,036 divided by 10, 487, 542 is down 4.7. So 0.03% better. But pretty interesting that that we're making up at least 0.8%, sometimes 1.2%. We are protected right now, and that's about it. You guys, any other questions I can answer for you? We just had Jeffrey leave us. Thank you, Jeffrey, for being here today. If there are no other questions, guys, have a great day. Let me get this posted. Look forward to seeing you next week. Next week I will be in Houston. So I'll be in Houston. With that said, you guys take care. Have a good one, and I will talk to you soon. Bye-bye, guys.